Scott Drake for Annuity News Now. To most people, bonds are considered to be a safe investment, especially when compared with stocks. But corporate and government bonds actually have their own unique risks. Here to discuss those is Chris Price, Director of Broker-Dealer Relations for Shurwest Financial Group in Scottsdale. Chris holds several securities licenses, including Series 6, 7, 24, 63, and my favorite, 65. Chris, welcome.
Thank you for having me, Scott.
Chris, I have to admit that when I think of a bond, I think safety, but Investopedia.com recently highlighted several risks. Can you explain them?
Well, first, there's interest rate risks. Interest rate risk is when, rates say, I'll give you an example for a visual. Interest rates are here on my left hand, and the price of bonds are on my right hand. When interest rates go up, the prices of the bonds go down. Inversely, they're going to work the same way. So when interest rates go down, the price of the bonds go up. And that's where we are right now. So what happened is when interest rates were still high, they started to make a move to the downside. When they started going down, it's a simple supply and demand thing where people say, well, rates are going down. We better go in there and buy as many of these bonds as we can. We want to lock in the highest rate. And because when they do, that supply and demand thing kicks in and says, well, everybody wants them, so it's going to drive the price up. Well, as they're driving the price up, the rates keep falling. So when rates hit the bottom, where we are right now, that's where we get the reaction that we're in.
Chris, if interest rates rise and bonds fall, is there a risk to investors then?
Absolutely. Going back to my other example, as interest rates rise, the values of the bonds fall, or the price. Okay. So say you have a bond, you buy a bond for $1,000 and it's paying you a 4% yield. Okay. It's going to pay you $40 a year in interest. So now the bond is paying 5%. And you say to yourself, well, I want the 5% instead of the 4% yield. So you decide to sell your 4% bond. Well, if you do so, you take that 5% and you divide it by the new $1,000 price for that bond, it's going to give you $200. Well, you have to subtract that $200 from the original price that you paid for your 4% bond. So you take the $200 away from the $1,000, means you're going to get $800 for your 4% bond. So essentially, you're going to lose $200 in order to reinvest it to buy a higher yield for yourself.
Chris, are there any other risk concerns you can think of?
Sure. There's credit risks, default risks, liquidity risk, and reinvestment risk. And actually, there's rating downgrades too. The credit, default, and rating downgrades all pretty much bundle themselves into one, because when downgrades come in, they're downgrading the company. They're saying, okay, this company is not strong enough, or we're not sure if they're strong enough to pay the principal and interest payments on their bonds. So it gives them a greater opportunity to default on the bonds they already have, or the bonds that they were going to come out with. So, and that shows that the credit they had when they started, so they had a good credit rating, now their rating went down, the chances for defaulting on the bond are greater. So when they try to go out there and borrow money from the banks, so they want to do another bond issue, the banks are going to say, well, your credit isn't that good. So like anything else, they're going to say, we're going to charge you a higher price on any loans that we give you, because we don't think that your capability of paying the interest and principal payments are strong enough to actually support the bond.
So Chris, if advisors are using an asset allocation model for their clients' portfolios, are bonds the only option for the safe money part of that portfolio?
No, Scott, there are other options that we can utilize. When you have fee-based managers, they're going to have asset allocations depending on the client's risk tolerances and their needs. So the safe portion of the portfolio is supposed to be the fixed income portion. So what we like to utilize is a fixed income strategy alternative. We know that you can pull those bonds out of there, utilize an annuity in its place. You're not going to have the reinvestment risk. You're not going to have the interest rate risk. You're not going to have the credit risk. Your principal is 100% guaranteed. You're going to get a solid interest rate, and it's going to take care of that safe portion of the portfolio. And that's what everybody's looking for. After what happened in the last couple of years in 2007 and 2008, people are really worried about what's going to happen with the market and the returns on their portfolios. So the idea is when you utilize an annuity in lieu of the bonds, what you're doing is you are really taking out the risk portion of it and giving them the safe aspect that they're looking for. So when you've got your growth side doing what it's supposed to be doing, whether it's growing up or going down, you know that that safe fixed income portion utilized in the annuity is always going to be there. That's the portion of the portfolio that's going to allow them to sleep at night.
Chris, it's been a pleasure. Thanks for joining us today.
Well, thanks for having me, Scott. It was a pleasure being here.
This is Scott Drake. You're watching Annuity News Now.